is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young. AY, last week we talked a little bit about how some of these DeFi names were catching a bit, and there seemed to be some renewed interest in decentralized finance, which was music to our ears, considering our podcast is called DeFi Decoded, which makes today's guest kind of very timely, and I think really the perfect person to build on that. We've got Sid Powell, who's the CEO and founder of Maple Finance. Maple Finance is an institutional on-chain lender. Sid is a repeat guest. He has been on the show before to talk a little bit about the kinds of ways he is building new financial utilities on chain, both for the institutional market and the broader market as well. There's a half a dozen really great topics that I want to dig into on this call. Sid's got some pretty unique perspectives on, everything from synthetic stablecoins, interest-bearing stablecoins, the on-chain lending market, like you name it. But first, before we dive into all that, Sid, welcome to the show. Nice to see you.
Thanks, Alex. Good to be here again, and nice to see you again too, AY.
So I realize I missed out on ETHDenver, but both you guys were there. AY sounds like you were having some fun at ETHDenver, but I'm just genuinely curious from both of you to know, before we dig into these topics, what was the mood at ETHDenver? It seemed like from what I saw on Twitter that there was a newfound optimism. I would say even some irrational optimism around lots of different things in crypto, which is a nice thing to see maybe after the year and a half that we've all been through. So Sid, why don't I start with you? What were your three kind of key takeaways that you found from ETHDenver this year?
Yeah, I thought it was a much more positive vibe this year. I know you mentioned irrational optimism, and it does seem in the space we kind of, we kind of spiral between irrational optimism and irrational pessimism. And last year I would have characterized it as irrational pessimism. So it's kind of nice to see the pendulum shift. But for me, the big ones were we are seeing more DeFi come through. I think last year it was very much infrastructure was the story. Infrastructure is still grabbing a lot of the big headlines when it comes to capital raising, but it's nice to see DeFi picking up more of a bid on the narrative side. The other ones that came through from me were stablecoins continue to be a very hot topic, both stablecoins and synthetic dollars, exemplified by projects like Athena, and which I think just hit 800 million TVL today. And then RWAs, so real world assets, continue to be a hot narrative. Though for me, there's a bit of grayness around the level of adoption that's currently coming through at the moment. But so those were my three takeaways. So stablecoins, RWAs, and DeFi picking up more of the narrative.
Can you just give us a high level, what's a synthetic stablecoin? Because we've talked about there's traditional centralized stablecoins, which are backed dollar for dollar by collateral that's held in a financial institution. And then you've got what we used to call algorithmic stablecoins, which maybe you don't have a full peg and there's some kind of mechanism to hold the price. Is this a rebrand for algorithmic stablecoins?
I'm by no means an expert on them, but what I would say is an algorithmic stablecoin doesn't maintain full backing. Instead, what it is that it's concentrated liquidity around the peg that is aiming to maintain it through on-market activity, so buying and selling to keep the peg. A fully fiat-backed stablecoin is exemplified by Tether or USDC, where you're holding Treasuries, money market funds, and other liquid assets against it. And then you have collateralized stablecoins like DAI, which are using, DAI is actually a mix now, but using things like Ethereum to maintain the peg. But this one, so this synthetic dollar idea is using a market neutral strategy. So effectively, it should be backed by redeemable assets, but the redeemable assets are effectively a tokenized version of the basis trade. So you would be long the spot asset and then short the perp, and you are generating yield, which is the basis trade from that market neutral position. That generates interest on the position, but the backing is actually that market neutral position. So if Ethereum drops in price, the short perp is making money, and if it gains in price, then the long spot is making money. But theoretically, that's what maintains the peg, and the fact that it's redeemable through that mechanism. So Athena's a more recent example of that.
And how long has Athena been around for?
Um, only a matter of months at this
Okay.
stage,
And
so it's relatively new. So it's hit about 800 mil TVL. So it's enjoying rather rapid growth, and it is one of a crop of new stablecoins that have come through. This is that synthetic dollar idea, and then you have others that are attempting to be more of a euro dollar for offshore usage. So an example of that would be Mountain Protocol, though again, Mountain Protocol is really backed by fiat reserves.
Yeah, I love the use of the term Eurodollar because that's something Andrew actually brought up on this exact show like a month ago, talking about Tether. Basically, it's
Yeah.
like this source of US dollar like liquidity that is really only accessible outside of the United
Yeah.
States.
Tether's Tether's main areas of adoption tend to be emerging markets.
Yeah,
Like it's extremely popular in regions like Africa where you would not want to hold the native fiat currency because it's one, really costly to do remittances, and two, you're at risk of inflation. So which tends to be worse in emerging markets. So Tether is actually a fantastic product for people in that part of the world. They can get interest on it through staking, and it's super low cost for them to remit.
and let's talk about Mountain Protocol because that my understanding is that's one of those stable coins that passes through interest income from collateral. So like if the collateral is
Mhm.
treasuries earning 4%, it gets paid out as like a, I guess like a kind of an airdrop
Rebase,
to
yeah, yeah.
the wallet effectively in Mountain Protocol's stablecoin. Is that right?
Mhm.
Like effectively?
That's right. Effectively, I'm going to butcher the legal structure behind it, but let's just say it's like a unit trust. It holds a bunch of um, low risk government debt securities like T-bills, and it passes through the interest to holders. Mountain Protocol is limited to people offshore to the US, hence the euro dollar moniker. But it passes it through in a form of rebasing. So rebasing basically means, Alex, if you held $100 and you're collecting a $5 interest rate or a 5% interest rate, then at the end of a year, you would have $105 in your wallet. So it's actually expanding the supply of dollars that are held in your wallet. That's what rebasing refers to, as
Yeah,
opposed to just giving you like a redeemable exchange rate where you can send your tokens back and get $105.
interesting. So Mountain Protocol today has got, I'm not DeFi Llama here, $152 million.
Mm-hmm.
Is yeah, I'm not asking you. You're not an expert in Mountain Protocol. Is that on the Ethereum network, or is this? Yeah,
Yeah. They might be on one of the L2s, but as far as I understand it, that they are active on the Ethereum network. I've actually had the pleasure of meeting the founder of Mountain Protocol, Martin. So really strong financial background,
yeah,
and has put a lot of thought into it. And I do know some of the backers as well on the venture fund side.
yeah. Well, I think Nick Carter's a backer, right, of the
Yes.
Mountain Protocol.
Yeah.
He's a big personality on Twitter. I feel there's so many things I want to get into, but I know that the opening question was like, what was the takeaway from ETHDenver? So, AY, what was your big takeaway, or what were your three big takeaways?
Yeah, definitely. I think the first big takeaway was sort of what I would call almost like revenge of the ETH killers, and what I sort of think of as like the next generation of sort of new L1s that have really captured a lot of developer mindshare, and I think are poised for pretty huge growth. So while we were actually at ETHDenver, I would say like the first of these sort of launched, which was I guess this isn't really an ETH killer because it's an L2, but Blast had launched right when we were at the peak of ETHDenver, and it sort of went crazy. I think it had multiple billions of dollars of TVL shift over right away. So I thought that was really interesting. And then the two L1s that everyone was talking about when I was in Denver was Barachain and Monad. So Barachain is effectively an EVM compatible Cosmos chain. Uses this open source tech called Polaris, which I actually believe they're the main contributor behind. And what's cool with Barachain is they're actually building a lot of their own sort of core apps on the L1 itself, and then creating their own native stablecoin called Honey. And then besides that, it's just also got a great community. It's like all about like these bears and doing ridiculous things. We should get the Barachain founders.
Can you
actually
explain that? What does that mean? Bears doing ridiculous things.
I mean, it's essentially
Barachain.
Yeah, Sidney, do you want to explain? Essentially, it was Barachain initially started
bong bears.
Yeah, exactly. It was a bunch of bears. It was like an NFT collection of bears smoking weed. And then
those guys. I've seen those.
Yeah. And then it's become this like huge thing. They've raised significant capital and they've built a huge developer community. So pretty excited about that. I was at the Bearapalooza.
Yeah.
I was at the Bearapalooza event, which had 1,000 people at it probably. And then Monad, which is almost, they haven't really come out with their DevNet yet, testnet yet, so it's hard to know exactly how it works. But essentially, they have 10,000 TPS. The easy way to describe it is almost like Solana for EVM, but that's obviously a huge, generalization. But yeah, I think those were kind
pitch, though, right?
It's a great pitch.
If it's a Solana that you get to be Ethereum compatible, I don't know. That seems enticing.
Yeah, no, and I really like the Monad team as well. I was at their event. Really excited about that, and I think they are sort of like they're a little bit further away, I think, from their launch, but definitely getting a lot of hype. So those are probably like the two to watch out for. I think both are expected to launch this year. So that was one. Number two was restaking. So I'm sure, Sid, you were hearing it everywhere, but everyone was talking about Eigenlayer. How you can essentially, again, I'm not an expert on restaking, but effectively it allows you to reuse staked ETH to secure other chains. I think now there's 3 million ETH in it, something crazy. I have to get the exact numbers.
Yeah, worth talking through like the dollar value there. So dollar value equivalent, you're looking at multiple billions staked there.
Yeah, which is crazy. I'm actually curious. I'll just touch on the last thing, but I do want to retouch on the Eigenlayer. The third thing I would just say is just like overall, complete animal spirits back. You're hearing about private seed rounds being done at pretty crazy valuation. So I think we're sort of back to where we were, particularly in the private market. The liquid market is definitely heating up as well, but it does seem like the private market is extremely hot. So going back to that second thing, I'm actually curious, Sid, how do you think of like the restaking, and I guess like almost like what Blast is doing, which is reusing staked ETH. How do you think about that in the context of like lending? Does that give you guys a potential opportunity as well? Just because to me it's almost like rehypothecating staked ETH multiple times over, and allowing you sort of like reuse like capital. So I'm just kind of curious, like how does that fit within the context of like institutional lending or just the DeFi lending markets in general?
It's a good question. It's an added form of leverage because you're effectively getting an asset that you can derive two sources of yield from. So you can get the staking yield and then you can get the yield from restaking it. I do see restaking as being a source of leverage for this coming, or the bull market that we're already in, effectively. And because you'll see people rehypothecating those assets and then trying to juice the yield that they're getting on them. And when they can get a yield that they think is quite favorable there, as well as capital appreciation, they will want to borrow against that asset to leverage it up. And so they'll, put it down as collateral, borrow dollars, buy more ETH, stake it, restake it, and then try and lever it up again. So I do expect that you'll see protocols emerge that can provide leverage against it. We would consider it. We currently do lending against staked ETH and against staked Solana. I think the key thing is just risk mitigation. You obviously have to watch out for the quality of that collateral, because I think one of the big unknown things is probably people are statistically underestimating the likelihood of either slashing events or slashing events on restaked collateral. And so I think that's one thing that people just have to be mindful of as they look to lend against those assets. And that's something we think about. But if there's a way to profitably earn yield by lending against it, and you control your LTV and you control your counterparty exposure, then I don't see why it wouldn't make decent collateral.
Yeah.
Fascinating. Yeah.
Yeah, it is fascinating. It's a whole new world. It is interesting, like the new ways to get leverage in this bull market. I think that's kind of like one of the themes for this bull market is how we're moving away from, kind of like the Celsiuses of the world, the centralized exchanges, to this like new forms of leverage where they're almost like blockchain native forms of leverage. So I know Alex has a ton of questions. Sorry, Alex.
Well, I was going to say that's a perfect segue, actually, Sid, into what's new at Maple. Speaking of on-chain lending versus centralized lending and on-chain financial services. It's interesting, it strikes me that two of the big topics that have come out of ETHDenver were synthetic stablecoins and rehypothecated assets, which are two things that I recall got us into some trouble the last time around. But maybe this time will be different because it'll be more transparent and the liquidations will happen faster and be automated. Maybe you can shine some light on how Maple Finance is thinking about that. Obviously, after the last cycle, there was a big gap in the market left behind by some of those bigger players like BlockFi and Genesis. And I'm so curious to know how you see that as an opportunity, how you're exploiting it, and where you plan on growing next.
Yeah, for sure. And there's a lot in that question to unpack. But I'll start with a bit of background. So when Maple was coming through the last cycle, it was doing a lot of unsecured lending to market makers, market neutral funds. And that was because the space of over collateralized lending was already so well catered and so well, so crowded. So we couldn't have got a foot in the door there and been competitive. Now, those firms, Genesis, Celsius, BlockFi, were a huge part of that market, and that market segment is now largely absent as we come into this cycle. And so the opportunity that we saw is fulfilling or providing that product, which is secured over collateralized lending. So we launched Maple Direct last year in August. Since then, we've done about 70 million in originations, and that was mostly against BTC and ETH, so fairly conservative collateral. But what we've done now is expand and look at taking SOL, AVAX, ADA, XRP, Filecoin, so the larger cap tokens that are fairly liquid in case you need to liquidate. And what we think is two things. This service is really needed in the market because market makers do need inventory for proper execution on exchanges. So you're not going to be able to see the type of trading volume that is required in a bull market absent this kind of lending activity. But two, that it's extremely important to do this in a very transparent way. So all of Maple's loans sit on chain, and you can see in the web app the collateral against each loan and the health of each loan in real time. And I think that is something that was absent from the CeFi lending segment last cycle. You never knew how much equity capitalization they had, how over or under collateralized they were. And also everything was typically happening on a single balance sheet for each of those players. Whereas here, what we've done is we segregate and silo out the risks. So you'll have a segregated pool that is doing loans against SOL, SOL, ADA, AVAX, and the tokens that are liquid, but not as liquid or low risk as BTC and ETH. And then you see a separate pool that is doing the BTC and ETH collateralized lending, and then another one again that's doing the altcoin lending. And so that just prevents commingling of these risks and ensures that when you participate in one of these, you know exactly the kind of risk you're signing up for, and you can monitor the health in real time. The one other point I'd make is that a lot of those platforms before were very retail driven, and so they had a large concentration of retail deposits. And that's something that's missing this cycle because that then created huge balance sheets and volumes that could be lent out. Whereas we are only dealing with accredited investors. We're not dealing with retail mom and pop depositors. We're only dealing with accredited high net worth funds, family offices, and institutions. And so that means that the amount of capital that we can aggregate is a bit different. It's probably not as high because we can't take that kind of retail flow, but it also means that the parties we're dealing with, they fully understand the risk. They don't think they're getting some kind of risk-free offering here.
Interesting. Yeah, so the idea of segregated pools, like isolating the risk, or at least the lender knows what they're lending against, and the idea of focusing on institutional only, I think both of those are really interesting. I mean, the institutional only one is helpful too, because let's be honest, those retail focused platforms, the last cycle were misrepresenting a lot, I think, and making promises that they could not deliver on. And with institutional investors, they're just much more sophisticated, we hope, and more realistic about risk and about expected return. So I think that's like a much more like durable foundation for the business. How big do you think that can get, though? Like you mentioned, you can't get that big, or you're missing the retail flow. But like, how big is this on-chain institutional only market, you think?
Yeah, so all told, the size of the market last cycle reached about 55 billion, and that was across those major platforms in dollar value. And so let's say that the institutional markets, maybe even if we just assume it's like a third of that size, you're looking at, what's that, like 15 to 20 billion, like a touch under. And so that's that's a fairly conservative target. That's also not factoring in any growth. And typically in crypto, we do see that each cycle sets a new higher high in volume and activity. And so at our peak, Maple was a touch under 1 billion in loans outstanding. And so if you just look at the difference between that 1 and 15 billion, there's a lot of ground that we can catch up that's not being chased by as many competitors this cycle. So we think very healthy opportunity if we back ourselves to kind of serve that market. We're also quite public about it, and we have spent about 3 years establishing relationships with all of these OTC desks and trading firms so that we can, get access to the deal flow there.
Yeah, I mean, like the target market is the commercial lending market, which is trillions and trillions of dollars, right? Like if you believe
eventually, yes.
Yeah, like if you believe that transactions will migrate to more and more activity, whether it's the trading of stocks, RWAs, loans, what have you, is on chain, then that's like the sort of the terminal value of what the potential market could be.
100%. I see no reason this wouldn't be that.
Your 15 to 20 billion target is pretty conservative. Mr. Fink thinks it's in the trillions of dollars. So you got to up those numbers. Those are rookie numbers, Sid. Come on.
What's it?
Managing expectations too hard.
Sid, what do you think of because I also think of kind of like the commercial lending space within deep crypto to be the main sort of commercial entities are like protocols and DAOs themselves. And what's interesting with this cycle is DAOs and a lot of these crypto protocols are now actually starting to generate real earnings. And that's purely on-chain cash flows. Is that kind of like a sector you guys have looked into a little bit? And if so, kind of like, I guess, what are the benefits to it and downsides to it?
It's a good question. It's definitely one I've looked at. And last cycle, I'll point out, so last cycle there was a product called Porter Finance that was trying to do loans against tokens to a DAO, and it was going to be substantially over-collateralized to mitigate its risk. They got one loan off to Ribbon Finance. I know the founder of Porter. I think he was a really sharp guy. I think one of the issues was the volatility of the DAO's token and also the wrong way risk. So if you think about it, if you're giving a loan to somebody and you're collateralizing it in that token, then the token's value is going to be correlated to whether they perform the loan or not. Whereas what you typically want is something that's uncorrelated. Like I wouldn't want to lend to you, Andrew, and take Andrew tokens as collateral, because odds are if you default on the loan, your Andrew tokens are not going to be worth as much in the secondary market. But the key issue we found with the DAOs was, one, the durability of those earnings. So I definitely take it that they can earn quite well in bull markets. But how durable are those earnings? Often they're kind of driven around token incentives. And so perhaps if the token incentives run out, then the revenues dry up. And then second is this is more of a qualitative factor, but the caliber of management there. So often you'll see it might be an anonymous team. Maybe they have a founder breakup and then half the team walks. Maybe they misappropriate funds. You saw like Magical Internet Money, Wonderland had that last year. You can also have a key component of the core team kind of depart. Recently we saw Aave part ways with Gauntlet, who was their primary risk manager and who helped them navigate the issues with the curve-backed, CRV-backed loan. And so all of those kind of impact the durability and the ability, I would say, of these protocols to repay. Plus the how do you enforce? Like a lot of these teams are like fully remote, and to the extent that they're in a jurisdiction where you can't reach them, then you're going to have difficulty clawing back the funds. All that is to say, though, I'm still readily looking at it, and I mention all these things because we think quite deeply about how we would do this product in future and make it compelling. One of the things we're looking at the moment would be venture-style debt to pre-token projects, where we could convert into the tokens upon launch.
Yeah, sorry, that's really interesting. Sorry, I'm just thinking about that. That is, I guess one thing that's cool is if you could sort of programmatically take the earnings from the DAO to pay back the loan, but
DAO looked at doing that, and Credit Co-op, and the idea was effectively a sweep account. So you have a smart contract that takes the revenues and garnishes them to pay your interest and then amortize the loan. I think that could work. One of the issues is actually embedding it in the protocol. So you kind of need to get in quite early to embed that in the smart contract code for a protocol when it launches. Otherwise, you then have to kind of redeploy the entire protocol, which can be technically quite challenging and costly for a project. But I do think that's an interesting way of kind of mitigating your counterparty risk by just saying, well, as long as we know money's going to go through there, nobody has discretion to stop us from getting paid.
Yeah, that makes sense. Maybe like L2s themselves would be almost a better market, just because they have more flexibility as well. And they're probably a little bit more permanent, but probably need an explosion in L2s and things like that first. So definitely seems very early.
Yeah. And I do like the L2s. I think you'd only have a narrow number at the stage that you could do, just because one, L2s are an extremely hotly contested space. I would say the barriers to entry dropped pretty significantly over the last year. And also it was so frothy in terms of the valuations kind of getting thrown there. So you can have a lot of L2s that could actually operate without generating any cash flows, almost as zombie chains for the next couple of years, particularly if their token appreciates over the course of this bull market.
Hey, Sid, do you ever think about doing anything with these projects that have large token treasuries? Like doing sort of yield optimization or doing something with those, they're sitting on big piles of their own token, which if they sold it would crush the price, but they have a value which people may want to, lend against or borrow against. Have you ever thought about that?
Yeah, for sure. So I think there's two product options there that we've considered. One has been lending against the locked tokens of early investors, because they might be on a multiple, let's say like a 3 or 4 year schedule. And what you could do is you could lend against it a fairly conservative loan to value ratio, fairly high coupon rate, and then if they default, you could take possession of the tokens effectively. So that's like
locked tokens, like you.
Yes, yeah. Because the reason that's come into focus is because FTX Estate is doing a massive sale of locked SOL that's on a vesting schedule of kind of up to 5 years. And so we know a number of VCs who are putting in bids there. It seems like it's going to be extremely widely syndicated, and we've thought about financing that. On that one, you actually have an even better credit counterparty profile, because you have the fund, and the fund will secure your asset. So you get the lien on the locked SOL, and then typically the fund is going to have, tens, if not hundreds of millions of other assets that also form, effectively a cushion against you taking any losses on it. And the fund wants dollars so that they can be fully deployed and continue investing into deals that are coming up at this stage in the cycle. So it's good for them. It's good for us. I think it's actually pretty low risk. For the protocols themselves, we would be open to kind of yield optimizations. One of the things they could do is they can lend their tokens to us. They can typically fetch a very good interest rate with market makers. And what we would do is manage loans across several market makers that either don't have the kind of the call option built in, or have an interest rate that needs to be paid to these foundations. Typically what happens is the foundations will do a transaction that is very profitable for a market maker and very unprofitable for a foundation, which is they lend it for free, so no interest, and then they embed a call option in there also at no price. So the market maker will not really pay for the value of the embedded call option. They get that for free. And I think there's a long way to go where foundations could actually optimize this by working with a credit structurer like us, who would spread that across 4 market makers, get them a good interest rate, and make them pay for the call option, which is typically worth hundreds of thousands of dollars, if not millions.
Interesting. Yeah, it seems like a huge opportunity, especially as you say, as the value gets inflated. the locked SOL is worth 10 times what it was this time last year, or whatever, 7 times as much as it was last year. Speaking of, well, this is a bit of a segue, but something you mentioned in the opening remarks, actually before the call, about RWAs as a theme, and how weirdly, because there's so much interest in these what you might call speculative investments, projects that have huge upside and maybe big downside, there seems to be like almost less interest in the idea of using blockchains as a way to to bring real world assets on chain, because earning a reasonable rate of return for taking a reasonable amount of risk seems less interesting in periods of
a bull market.
Irrational exuberance, right? So talk about that a little bit. How does that might maybe relate to Maple?
For sure. So RWAs, so real world assets, were a huge narrative trend last year, and that was it was a great time to invest in that type of stuff. And so you saw the quintessential RWA was tokenized T-bills, which got up to more than, I think it was about 850 by the end, 850 million in those types of protocols by the end of the year. Maple participated, so we had a tokenized offering where we would do loans against pledged T-bills as collateral, and it was a good way for it had a number of driving factors. One of them was actually the fact that the banking system was trying to choke off supply to crypto companies. So Operation Choke Point 2.0 was basically banks would unbank crypto firms, even if you're only tangentially involved in the space, like a software development firm or an audit firm. And that meant you might be sitting on stablecoins that you needed to get a low risk yield on. So you would turn to protocols like us, Ondo, OpenEden, Centrifuge. There are a number offering those tokenized T-bill products. And that was also, it was also driven by the fact that risk-free returns were getting towards 5%, while on-chain basis was pretty low. So the opportunity cost in crypto was very low, where you weren't getting good alternative sources of yield or return. Fast forward to today, and that's kind of gone away. And the reason for that is we're in a bull market, so people are going risk on. They're trying to buy the market and so get beta exposure, or they're making LP commitments to funds, or they're farming airdrops. So you had Jupiter, Jito, you have Eigenlayer coming up, you have Athena coming up. There's a number, EtherFi. There's a number of these points programs that are promising very healthy APRs or return profiles, and that's attracting people. The other thing, though, is because we're in a bull market, the basis trade is paying a fortune. So it's paying, north of 50%, just being net market neutral, doing, Tether stablecoin basis or a BTC basis. And so that means, why would you go and lend on a 2-year basis to a private credit fund and get 9, 12% when you can go and put a market neutral trade on? You don't even have to lock it in for 30 days and you can get paid multiples of that. And you can get paid that as long as you think a bull market is going to persist, which is because people are paying for leverage through these centralized exchanges. So what that's done is it's pushed up the rates that you need to charge for crypto native lending. And that's why the market's kind of coming back at the moment. So very profitable opportunity if you're doing this crypto native lending.
So just a quick question on that. Like, given that explanation was like a masterclass, and I think I understood about 2/3 of that. My question is like, if you can make 50% doing that, why don't you just go raise money, Sid, and do that yourself? Like, given your knowledge of the space, like, can Maple Finance do this kind of strategy on a prop basis as part of its like operating business, or is that like a distraction, you think, from what you're currently doing?
It's something I've actually thought a lot about over the last couple of days, given we've seen the opportunity come up. We don't want to be like a kind of market neutral trading firm, but putting on a relatively uncomplex trade like the basis trade, just as an alternative for parked cash, and then what you would do is is something that's potentially attractive. And then as soon as there are opportunities to lend it out at an attractive rate of return to institutional counterparties, then we could put it into loans. But at the moment, the alternative that we're putting money into when it's not being utilized is, T-bills, which is about 5%. So provided, and there are a few ways that you can put the basis trade on. I mean, Athena in one sense is just a tokenization of the basis trade. So you could do that. Or you can just put it on directly across several centralized exchanges. But I do think about that because Otherwise, what happens is you're kind of forced to accept lower rates of interest or below market rates of interest if you're sitting on too much capital that you can't deploy in one of those strategies yourself. So it's something I think about, but it's not something that we've kind of put in place, and it's probably not in the immediate short term.
Yeah, interesting.
Yeah,
Dark Dynasty, any comments?
No, yeah, it is. I mean, it is really interesting. I think one of the things I'm more, I guess, to broaden this out discussion a little bit to kind of like the future. What do you think are like the next big sort of innovations in DeFi? Like, I guess, like, what do you think are the things that haven't really been sort of explored yet? I mean, I think like some things that kind of come off the top of my head are like, I don't know, interest rate swaps, things like that. Like, and I guess how are you guys sort of preparing about that? Like, I know we talked a little bit about kind of like the whole DAO commercial lending, but as you know, I like to talk about kind of like the crazy future stuff. So, what's the crazy future stuff that you're sort of excited about and sort of see coming down the pipeline in the next kind of 1 to 3 years?
Well, I'll look at any kind of crypto native lending, and so I have a lot of ideas about things that we could do in future if we had demand for it. And so I can talk about those, and then I can kind of talk about the evolution of lending. So I'll just talk about some horizontal opportunities, which would be NFT lending. I think is going to be big over this cycle. It's a good way to get like a really high ETH yield, like much better than you can get staking ETH. So I think 12 to 15%. And what I've thought about is doing that in like a structured CLO format, where you have somebody beneath you who can kind of absorb some of the losses if the value of the NFTs fall. So that's one thing I've looked at. The other one is as a startup, we had to pay an arm and a leg for smart contract audits, and I think about doing invoice finance. So I think about almost buy now, pay later for smart contract audits, because what you can do there is you could effectively buy the invoice, which might be $250K at a discount, and then you extend payment terms for say 90 days, 3 to 4 months for a startup who's already got good venture backers. You know that they have the cash there, but they just don't want to pay out 250 grand in a single invoice. And so you give them payment terms on it. They're going to be more likely to go with the audit firm who can offer them that. And the audit firm is going to therefore win more business. So it's good for them, good for the startup. And it's crypto native, so a bank is not going to touch this in 10 years. But I think of those as like attractive horizontal opportunities. And then if we look in the vertical opportunities, which would be what would we pay service providers for as a lender? And some of these things would be like credit default swaps, tranching. So I think tranching is the next one that needs to be unlocked so that you can really grow the space. And the reason for that is that you have credit like lenders or debt investors who have different risk return profiles. So somebody might want a very low risk, lower yield, medium risk, so mezzanine, a mezzanine tranche, and then someone might want a junior sort of high risk, high return tranche. But that is best done by taking a single pool of assets and tranching it out, so you can kind of create that structure. Whereas otherwise you have to find an entire business or asset to lend against that just produces either high risk or low risk returns.
Well, in a way, I mean, Sid, like by segregating pools by asset, you're not tranching.
We're kind of doing that, in a unitranche way.
Credit, but it's a collateral tranching, right? Like it's based on the stability of the underlying asset. Yeah, I think that's a critique I've heard. I don't want to like open up a whole other tangent. Like this is a critique I've heard. Of DeFi is it's just it's very capital inefficient in a way because it has the same interest rate for everyone regardless of their credit worthiness, right? And that's like it doesn't really make any sense. It's not the way the world works. People who are higher risk usually require higher interest rates, to compensate. That's why credit card debt is more than the yield on a T-bill. That's just the way the world works. So the idea of figuring out a way to do that on chain, I think, is just like fascinating and could obviously uncork tons of growth for sure. Yeah.
I agree. And I think real world assets is something that I do think has a long-term, very bright future. I view it as kind of a linear growth that you'll continue to see. We haven't really hit a bit of a hockey stick with the T-bill stuff last year. But I think I basically view it as like it's on a linear, very strong trend. But what happens is that the crypto market whipsaws around it, almost like your old school diagram of the business cycle, where you have long-term steady rate of growth and business cycles of expansion and contraction. And currently we're in a point in time where the crypto native market is more exciting. And that's why RWA assets are at this stage being pushed more by issuers. So Larry Fink talks about a lot. Well, that's because he wants to get his assets on chain and distribute them. But there's no buyers on chain who want Larry Fink's assets. Like if you're crypto native, you're looking for higher return than he can offer. And so you're just not that interested in a tokenized, BlackRock fund on chain, or same with like KKR. I think what people do want is crypto native higher yields. When we hit the next bear market, though, that will flip, and people will really want, conservative, uncorrelated BlackRock fund returns and try and get those on chain.
Yeah, totally. All right, Sid, we could go on and on and on, but this is a really great discussion. Glad to get an update from you. Lots of really exciting things in the hopper, so we'll have to touch base in a few months to see how things have progressed. Love the update on ETHDenver, and AY, thanks for your insights on that as well. That's it for this week's episode of DeFi Decoded. That was a great discussion. We're looking forward to many more like it in the future. Please join us. Remember to follow us on Twitter. Give us a like on YouTube. And I'm at Alex Tapscott, and Andrew's at... Andrew, what's your Twitter handle again?
Sorry, to me?
Andrew's
what's my Twitter handle? Yeah, sorry. My Twitter handle is Andrew at @AndrewYoung_SX.
Okay.
Awesome. And I'm at Syrup Sid.
Yeah, Syrup Sid. And Maple Finance, Sid, where can people find out more?
So you can find us on Twitter at Maple Finance, or our website is maple.finance. And if you go there, you can access the app, and that's where we have all of these institutional lending opportunities.
All right, awesome. Lots of things for everyone to follow as the next step. We'll keep you posted on everything that's going on with Maple, and this episode will go live on Twitter and everywhere you get your podcast. That's it for this week. We will see you next week. Take care.
Awesome. Thanks for having me.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.